Hey there, and welcome to Real Investment News. I'm Mike O'Neill. Here at Real Investment News, we kind of like to take a look at the markets, break them down, take a look at what might happen next. We can't predict the future, but we do have some hints when you look into the past. Now, first thing I want to show you where we are right now. We have actually analyzed and realized that we have two major trend lines. First started in 2009. This is the main trend line here, but in February of 2016, you can see how things accelerated. And so now we want to know what is going to happen next. And for that, we bring in Jesse Colombo, analyst for Real Investment Advice. How you doing?
Excellent. How are you?
Excellent. So you actually broke things down into three scenarios, and we're going to take a look at these. You wrote a column about this. So the first one, and I don't like the sound of it, you wrote imminent breakdown, and for that, you spoke about the NASDAQ back in 1999, and just to give a little room, I'm going to step aside and show us what we're talking about here.
Sure. Well, I wrote about these three scenarios, but they're not in order of probability, so don't pay too much attention to probability or step one versus two versus three. It's just laying out three ways that it could all play out. But in this scenario, it's imminent breakdown, where you have, first of all, starting out with one trend line that's not as steep as the latter trend line, and the market's climbing up, and then finally launches a much steeper rally. And that marks the end of the bull market once the market breaks below that steeper trend line. Then it basically bumps around and consolidates for a little bit, and then breaks below the longer term trend line. So that's my concern, is that really what's happened is we've already broken, at least in today's market, we've broken below that steeper trend line, and we're currently in that stage where we're just bouncing around. And market participants are trying to figure out what's happening in the market. They're reading so deeply into every day-to-day move. My caution is that it's just a lot of randomness and slop and chop until there's either a breakdown from the other trend line that's not as steep, or it can manage to go back and regain the prior highs, which I think is less likely. So I just want to see if there's going to be a breakdown from the other trend line.
Okay, so that's great. Yeah, so this is actually kind of where we're at right now. If you step forward a little bit here, yeah, so we can see, yeah, this is what we saw earlier with the S&P as we speak. But next we have what you call a topping pattern forms. This is looking at the NASDAQ back in 2007. I'll step aside again. Show us what you've got.
Sure. Well, there are different types of topping patterns, but one of the most common patterns is the head and shoulders pattern. You'll rarely have a market form a peak where it just hits a new high and then drops, and that's the peak of the market and just drops from there. Very often, and this is the highest probability scenario, you'll have some sort of a topping pattern where the market will form two peaks or three peaks in the case of this head and shoulders pattern. This is designed to trick investors and traders to getting in. So for example, at this head pattern, very often you'll have new market participants jumping in because they see new highs. They think the bull market's going to continue for another few more years. And then it drops down again. That means everyone who bought around this area is now at a loss. So now they're going to be forced to sell for the most part because they have red ink in their brokerage account. So then it forms a right shoulder where it rebounds. It gives people a little bit of hope, thinking, oh, maybe it'll go back to the highs, I'll recoup my investment. And then it drops even further and it breaks that neckline. So I just want to see if we're going to form another high in the market and forms that head of the head and shoulders pattern, and then basically plays out and builds a head and shoulders pattern. So that's another scenario.
Okay, so I don't like either of those because both of those point that we've got like more down days coming.
Right.
But I like this third scenario that you have. You're calling it setting up for new highs, and for this one we're looking back to 1998 when you had something called the Asian contagion. And go ahead and step over here and tell us one more time what you've got.
Well, this is the most straightforward pattern. It's quite simple. Really just what happens is there's a longer term uptrend line similar to what we have today, and the market soars, and there's an initial wave of euphoria, but then some sort of a panic occurs. In this example, this is 1998, the Asian contagion. There was an emerging markets crisis, and then a crisis in Russia, and it roiled the U.S. financial markets along with the rest of the global financial markets. Many people thought the bull market was over because the S&P 500 fell about 22% in just a few months. But it hit the old uptrend line and managed to bounce right off that level and then gun for new highs. And then the bull market lasted a good year and a half, almost 2 years after that. So I just want to see if that's how this is going to play out. And I'm not guaranteeing any particular scenario, just saying that these are the higher probability ways that this market can play out.
Okay, well, that's really good. So thank you very much. And so if you want to read more of what Jesse had to say, you can take a look at his blog on realinvestmentadvice.com. Jesse, so thank you so very much.
Thank you so much.
And thank you very much for watching. Have a great afternoon.